Hey everyone, welcome back! Well, finally. Seriously, finally. For the past two episodes I've been talking. I talked a lot. In the first one, I showed you how I generally look at the market and how I build a mental map of what's happening with all this AI hype. In the second one, I broke down the list of instruments I have on my radar, and I explained that just because the market is going up doesn't mean you should panic click buy. That not making a decision is also a decision, and that the cash sitting safely in your account is also earning something with current interest rates. Alright, that peace and quiet had an expiration date, and it just passed. Today is episode number 1 as far as my heart is concerned. Because today, for the first time in the history of this public portfolio, we are done with theory, we are putting our own capital in the game, and we are putting real cash on the table. Not theoretically, for real. Before we hit buy though, a quick technical note. I recorded this so you don't even have to look at the screen. You can just listen to it like a podcast, in your car, on a walk, wherever. I'll walk you through the numbers and the trades out loud and explain my thought process. The stuff on the screen is just a bonus. You don't need to have your nose glued to the monitor. And the disclaimer, without which we can't start. Do not blindly copy my moves. I'm just a random guy on the internet whose biggest hobby is investing. It's my passion, and I'm doing it publicly so that together, learning from my successes and my blunders, we can learn as much as possible. But I am not a licensed financial advisor. I don't know your financial situation, and I am fully aware that right after this episode, a correction might hit, and this portfolio will show a loss. I am ready for that. I hope you are too. Let's start with how we're setting up this project. The goal is to reach a portfolio value of $25,000, and we want to get there step by step. The portfolio is going to be built on regular, systematic deposits. And a quick note here. I don't know today exactly how big those deposits will be. I don't want to lock myself into a rigid amount like always $500 because life happens. Sometimes it'll be $250, sometimes $750, and other times maybe less. The most important thing is consistency. The funds will land mainly in the US market. We invest in the currency of the specific asset, and honestly, the currency risk hurts a bit. But I am consciously accepting it. I am deliberately not hedging against exchange rate fluctuations. It's my decision, and I know the consequences. What about a benchmark? I have to touch on this. It's something I'm still struggling with myself. And to be perfectly honest, I don't know yet. Seriously. It's one of those things I should have figured out before hitting record. But here we are. Normally, I'd say the S&P 500, and that makes sense because companies from that index will probably make up a significant chunk of the portfolio in the future. On the other hand, I'm also thinking about a benchmark based on global companies, MSCI World or something similar. Why? Because long-term, I want to build a portfolio with exposure to the best global companies and not lock myself ideologically into a single market. Markets rotate. The US dominates today, but history shows that leaders change. Keeping an open mind is key. For now, I'm leaving that open. I'll try to present a benchmark in the next episode after giving it some deeper thought. Let me know in the comments what you guys think. The bare minimum goal is definitely to beat inflation by 2 to 3 percentage points. Let's just say it straight. Why am I even doing this? In short, I want to reach FIRE, financial independence, retire early. My long-term goal is to retire at 40. And before some of you hit the comments to say it's science fiction or that I'm delusional, listen up, because this is important. My version of FIRE is absolutely not about eating scraps, denying yourself pleasures, and cheaping out on toilet paper. Not at all. It's about smartly managing the surplus, gradually increasing your income, and putting your capital to work while you sleep. It's an approach where your money works instead of you. But there's one more important thing. FIRE has different variations, and I chose a specific one that closest fits my philosophy, and that is Barista FIRE. What does that mean? Traditional FIRE requires building up a capital pile that generates enough passive income to cover 100% of your living expenses. Forever sounds beautiful, but to achieve that, you need to accumulate some serious capital. Using the 4% rule, assuming you can safely withdraw 4% of your portfolio every year, you'd need somewhere around 25 times your annual expenses. For many people, that horizon is either way too far away or just impossible. Barista FIRE is tailored differently. The idea here is to build up enough capital to generate passive income that covers a chunk of your expenses, say 50 to 70%, while allowing you to take on any job that brings you joy and covers the rest. Without the financial pressure, without the corporate rat race, without the overtime, you can work in a coffee shop, hence the name, or do something creative, or just do whatever simply because you like it. Because you don't have to. Because the heavy burden of, if I don't earn, I can't pay the bills, is completely gone. I guess it's just my nature that I can't sit idle, so I'd probably be doing something anyway. But to do it by choice, and not by force, is a completely different ballgame. And that is exactly why this portfolio exists. Not to show off, not to beat a benchmark, but to take it step by step toward that freedom, and to build it together with you, showing you how it looks from the inside. I have one more note before we get to the transaction. It's about psychology, because without it, the stock market will chew you up and spit you out. I already have my private portfolio that I've been managing for years. I have stable positions there. I have my foundation. And, just as importantly, I have a mental cushion, which means that here, I can afford to make mistakes and not panic when the portfolio dips. Now, a question for you. How are your nerves? Before you even think about throwing your own savings anywhere, ask yourself if you have that kind of peace of mind. Do you have an emergency fund completely separate from your investments? If the market drops by 30%, are you safe? Or will you be forced to sell at the bottom just because your car breaks down or your washing machine dies? Because that is the absolute core of the investing game. It's not about finding the perfect time to buy, it's about not being forced to sell at the worst possible time. And one more thing. I am fully aware that we are starting to buy when the market is high, near all-time highs. To give you some context, I actually have the Nasdaq chart right in front of me. I mentioned earlier that you can treat this like a podcast, so for those of you on the go, I'll just describe what I'm seeing, and the rest of you can glance at the screen. We are on a weekly time frame. The price right now is hovering around 29,150 points. It's high. If we measure it from the bottom in April 2025, the already memorable Liberation Day announced by the current US president, the index has skyrocketed by nearly 90%. Just the second quarter of 2026 alone brought almost a 35% gain. These are massive moves, and only now are we seeing a more distinct red candle forming. But let's be real, after such rapid, almost vertical climbs, catching a breath is completely normal. The market always, and I mean always, moves in cycles. And contrary to what it might seem, this is very good news for us. Cooling down overheated sentiment often gives the market the fuel it needs for the next breakout. Though, of course, nobody can guarantee whether this won't turn into a deeper correction. A skeptic might look at this chart and see a double top formation, although it's still missing a piece on the right side. If we drop down from the weekly to the daily chart, obviously we are closer to the moving averages, but the chart clearly shows that even with the current pullback, we haven't even dropped down to the 50-day moving average. By the way, I use the exponential one since it reacts faster to recent data. Not to even mention the 200-day average, which is safely hiding way down there around 26,000 points. The chart was basically stretched like a rubber band. It pulled really far away from its averages, so it's absolutely logical that the market eventually has to take a breather, consolidate, and pull back closer to the mean. Alright, a quick word on technical analysis itself, because I know the questions will come up anyway. I don't treat it as the only, primary, or best source of information, because at the end of the day, it analyzes the past and relies solely on probabilities. We need to be clear about this. Technical analysis is not an exact science, and its miraculous effectiveness hasn't been proven in any hard, empirical tests. But, at least to me, it perfectly visualizes the past and the current situation on the market. When it comes to individual stocks, I rely mostly on fundamentals. Fundamental analysis of an entire index is possible through aggregated metrics, sure, but it's much harder and requires a broader macro view than simply reading one company's balance sheet. Generally, I feel that when using technical analysis, you should stick to the golden rule of IT. KISS. Keep it simple, stupid. Don't try to look for overly complex indicators or force patterns on a chart just to confirm your own bias. Use the simplest ones, mostly because key moving averages and basic support or resistance levels are heavily watched by the majority of market participants, and for trading algorithms, they often act as critical zones where liquidity pools and orders trigger. And for you, they just provide a very useful data visualization. So looking at this map, the conclusion is brutally simple. We are entering at very high levels. We are buying expensive. And you know what? It stings a little. Seriously. But I also know the comment section might flood with people mocking this move, and I am 100% ready for that. It's part of the game. All right, time to shop. What's landing in the portfolio today? The first, primary engine and the foundation of this portfolio is the American Nasdaq Index. By the way, if anyone watched the first episode, you probably guessed this. I dropped a lot of hints, maybe even too many. To be precise, we are buying shares of an ETF with the ticker CNDX, tracking this index, for around $1,700. Why Nasdaq? Because right now it is the absolute epicenter of global capitalism and technology. Just look at the heaviest weights in it. Nvidia, Microsoft, Apple, or Amazon, companies that are literally changing the world right before our eyes. Nvidia is carrying the entire current AI revolution on its back. Microsoft is embedding AI into every single product in its portfolio. Amazon controls one of the largest cloud infrastructures on the planet. I want to build a strong, broad, diversified foundation to be as safe as possible on the stock market. And, I won't hide it, right out of the gate, I really don't want to underperform the benchmark. But let's pause here for a second, because I need to tell you something important. The Nasdaq is expensive. The price-to-earnings ratio is sitting slightly above 28 right now, and I know someone in the comments is about to type, "It's a dot-com bubble, it's gonna pop any second." So let's compare them, because it's a comparison worth making. The year 2000, the peak of the dot-com bubble. The Nasdaq's PE was pushing 150. 150. Today we are at 30. That's 5 times less. And more importantly, those valuations back then were based on literally nothing. Companies with zero revenue, zero business model, sometimes without even a product. Remember Pets.com? A company that delivered pet food, went public in February 2000 and filed for bankruptcy in November of the exact same year. 9 months from IPO to absolute zero. That is a bubble. What we have now is structurally something completely different. Take Nvidia. Their gross margin hovers around 75%. 75. For context, Toyota, a massive car manufacturer, is happy with a gross margin around 17 or 18%. Proportionally, Nvidia makes 3 times as much on every single chip they sell as one of the biggest factories in the world makes on a car. And the whole world is lining up for these chips, because without them, there are no data centers, no AI models, none of the things driving this revolution. This isn't a company selling pipe dreams. It is the bottleneck of the global digital economy, and they own that bottleneck. Apple, $100 billion in annual revenue from services alone. The App Store, iCloud, Apple Music, subscriptions, $100 billion. And this segment is growing faster than their hardware sales. That means Apple is slowly shifting from a phone manufacturer into a platform with a loyal base of 1 billion users whom they auto-charge every single month. It's a business model every investor dreams of. Yes, there is one argument I won't ignore. These companies are starting to hit the law of large numbers. Microsoft isn't going to double its revenue from 400 to 800 billion as easily as it once did from 40 to 80. Growth slows down by definition when you get this massive. And the market knows this, and it's pricing in scenarios that absolutely must play out for current valuations to hold up. If growth disappoints, valuations will drop, and it will hurt. That is a real risk, not just a theory. But my approach is simple. I am paying a premium for quality and for a market position that nobody can take away from these companies overnight. And I don't plan on selling these shares anytime soon. This is a position for years. I'll tell you what actually worries me here. It's not quarterly earnings, at least not right now. It's not the competition. I am afraid of politicians. And that's not just a rhetorical gimmick. Look at Nvidia and the chips. The Biden administration, and then Trump's, rolled out rounds of restrictions on exporting H100 and H200 processors to China. If you don't recognize the names, let me just tell you, that is the absolute top-tier gear. Those are the exact machines OpenAI used to train GPT-4. China was one of the biggest markets for these chips. Nvidia estimated their losses from this move at several $billion a year. Do you grasp that? Billions of dollars wiped out by a single executive order. And sure, for now, their stock is still going up because the rest of the world is fighting tooth and nail for this hardware and buying even more. But the signal is brutally clear. One signature from an official can chop off a massive chunk of a company's revenue before they even have a chance to react. Or look at Google and the antitrust lawsuits. Last year, a court ruled that Google violated competition laws in the search market. The remedy is still unknown, but a forced sale of Chrome or Android was legitimately on the table. Just imagine someone forcing you to sell off the world's biggest browser. This is a level of regulatory interference that would have sounded like sci-fi just a decade ago. These aren't made-up scenarios. This is happening right now, live. And when I buy the Nasdaq, I have this factored in. I accept that one press release from Washington or Brussels can shake the portfolio down a few percent in a single session. I can live with that. But I believe that lacking exposure to these companies in the long term is a mistake much costlier than that risk. Alright, we know what we're buying and why. Now, how exactly did I pick the instrument? Because that's a decision worth making consciously. When choosing an ETF, I always look at three things, which you already know from the first episode: the cost, the structure, and what happens to the dividends. Cost, meaning the total expense ratio. BlackRock's CNDX costs 0.3% annually. Sounds like nothing, but imagine two funds, one with a cost of 0.2%, the other costing 1%, which honestly isn't that unrealistic for actively managed funds. That's an 0.8% difference a year. With a capital of $50,000 and a 20-year horizon, that difference, factoring in compound interest, can amount to thousands of dollars. That is real money that one fund eats up and the other leaves in your pocket. Every single basis point matters, which is why I start with the cost. Structure, or the replication method. CNDX physically buys the stocks that make up the index. There are no swaps or contracts with a counterparty here. Synthetic ETFs can be cheaper, but for my core, long-term position, I do not want to risk a scenario where the counterparty on the other side of the swap defaults one day. That was a very real scenario during the Lehman Brothers collapse in 2008. Synthetic structures started falling apart because the other side of the trade just vanished. Physical replication eliminates that risk. And the third thing, accumulation. The fund automatically reinvests dividends instead of paying them out to my account. When dealing with capital gains taxes, every dividend paid out takes an immediate hit. By reinvesting it inside the fund, we defer that moment until we actually sell. Over a 10 or 15-year horizon, that makes a measurable difference in the final portfolio value. Compounding works best when you don't interrupt it. CNDX checks all three boxes, hence the choice. And this is my final thought before we wrap up. Just because we're jumping into the Nasdaq today and loading dollars into tech, doesn't mean I plan on locking myself in an ideological bubble. A good investor always has to keep an open mind and adapt to the situation. If in a year, 2, or 3, inflation spikes again or some bubble pops, I'm not going to stubbornly cling to one single theory. Maybe a time will come when buying physical gold makes sense. Maybe emerging markets, India, Korea, Vietnam, will get so absurdly cheap that it would be a sin not to buy them. Maybe I'll decide it's worth getting into a rental property for stability. I actually want to say a quick word about India, because it's a market I'm watching very closely. Honestly, it deserves its own episode, but I'll plant the seed here. Demographically, it is one of the most fascinating markets in the world. Over 1.4 billion people, a growing middle class, a rapidly expanding service and tech sector. India right now has what China had 30 years ago, but without the exact same political and geopolitical risks that eventually started dragging down Chinese valuations. It's not a position for today's episode, but I am watching it closely. Staying flexible is what keeps you alive in the financial markets over a 10 or 20-year horizon. We observe, we react to facts, not to wishful thinking. All right, the first building blocks are laid. The transaction went through. The public portfolio has officially launched. It's a weird feeling, to be honest. Looking at this confirmation screen, well, it's done. I have a huge favor to ask you guys. This channel is supposed to be a place to exchange ideas, not my personal monologue. If you have any ideas for other stocks, sectors, or specific ETFs that could round out a portfolio like this, let me know in the comments. I genuinely love to read them. And who knows, maybe one of your suggestions will land in the next shopping episode. One last thing to wrap up. Remember, this is an educational project. There will be blunders, there will be decisions I'll have to justify. The market is completely unpredictable, and I am not an oracle. The only thing I promise is honesty. I show you the screenshots, I read the numbers out loud, I explain my thought process. There is no magic algorithm or secret knowledge here, just a systematic approach, an open mind, and learning together. Thanks a lot for today. If you found this valuable, drop a thumbs up, hit subscribe so you don't miss the next portfolio updates, and I'll catch you guys very soon. Take care. Bye.